You guys already know that I'm always trawling on the Trading 212 app, so imagine my surprise when I found out that they have a new share lending feature. So in this video, I'm going to be explaining Trading 212's new share lending feature and how that could affect you as an investor. So you may be wondering how share lending works. So let's explain it straight from Trading 212 themselves. So one of the big ways that Trading 212 makes its money is through its contract for difference business model. Essentially, with CFD trading, you don't actually own the stocks that you are making money out of. What you're doing is you're borrowing these stocks from someone else in the hopes that it would go up or down in the way that you predict it to. And the difference between the profit and the amount that you borrowed for is the amount that you get to take home, minus of course the fees. So with share lending, essentially Trading 212 is trying to open up their platform and allow them to borrow some shares off its regular retail investors. So in exchange for you to lend your shares as a retail investor to Trading 212, they will split the interest they receive from that to you so that at least you get something beneficial from the deal. As we'll see later on, there are some risks associated with that and you should be compensated accordingly for that. So Trading 212 says that they lend shares from your portfolio to borrowers, so this is people on the CFD platform, and you will receive an interest for the amount of time that they're holding these shares. So Trading 212 makes it very easy. Share lending is completely automatic and you don't have to lift a single finger. That being said, when you do hold the shares, even though they are borrowed, you still will receive the dividends according to all the other dates, such as the ex-dividend date and the payment date, so you should not be affected in dividends at all. So like I said, because someone is borrowing it, there's always a few risks associated with that, and in order for Trading 212 to compensate for that, they are going to give you a collateral, meaning that if you don't get your shares back, you would at least get this back. So all lent shares, so the shares that you lend to a borrower, are secured by US treasuries. It's funny because the US has recently suffered a small credit rating shock, but other than that, the US treasury is still the gold standard of credit rating. And what Trading 212 essentially will do is give you 102% the value of your share. For example, if you had £100 worth in Tesla, for example, let's just say, they will give you £102 worth of US treasuries, so that if anything happens, you'll get back the amount that your share was worth. However, that being said, 102% doesn't always cover everything. For example, those shares that you bought at £100 could then be worth £200, and of course 102% of US treasury doesn't cover up from that potential profit. But this also goes both ways. If Tesla then goes down to £50, you will still essentially be receiving £102 worth of US treasury. The collateral is however adjusted daily, so like I said, if the price does change, the amount of collateral will change. However, we know how volatile the stock market is, and sometimes even daily is not enough of a time period to actually cover some of the losses and wins that do occur with volatile trading. So like I said, this is a completely automatic feature. All you do is sit back and watch the interest gain on stocks that you would have held on to anyway. The most important part about share lending is that there are no restrictions to your trading. So share lending will never cause delays or prevent you from selling your shares. So trading is unaffected by share lending, and you still will receive your dividends in full, provided of course you hold it before the ex-dividend date. There is also complete transparency with the whole share lending thing. Usually when you do hear a company opens up their doors to share lending, you do worry about their business model and their longevity, and also sometimes some shady practices. However, Trading 212 are saying that they're going to be completely transparent and they will let you see what stocks are being lent out and how much interest you are earning from these stocks. Furthermore, there are no commitments. You can actually wrap up this program if you want to. If you change your mind about it, you can cancel at any time, and it will take around 2 working days for this to start wrapping up. Now, if I go into share lending, as you can see right now, I have earned nothing. This is because shares are lent on a basis based on supply and demand. Currently, there is a lot of supply because people are holding onto their shares with Trading 212, and the demand is going to be a lot lower from the CFD platforms, which really does depend on what stocks are very volatile, because in the CFD department, volatile stocks are often traded more than non-volatile stocks. If you are an investor that just buys ETFs, you are probably not going to be affected by this at all, because I would imagine that most ETFs aren't borrowed as much as other individual stocks. Now, if we go into most borrowed, we can actually see the top borrowed stocks and the amount of demand they have for share lending. So as you can see, here are a list of what seems to be all individual stocks and corresponding numbers. So you can see on the far right hand side, it is the percentage value change, and they all look like they're in the green, but don't ever let that be the only indicator that you use to buy into these stocks. As always, this is definitely not financial advice, and I will never be telling you what stock to invest into. Now, the most important number is the APY. As you can see with Nikola, the APY is 28.77%, which is actually very, very high, meaning that if you hold stocks of Nikola, you will be receiving an annual equivalent of 0.28%. Now, it is very important that you don't start buying Nikola or whatever with a high APY, assuming that you're going to be getting a nearly 30% return for no risk whatsoever. Because the thing is, these stocks are super volatile. The other day, AMC was at the top and that was paying around 48%, but now it's gone. The demand is always going to change. The supply is always going to change. So please do not buy a company from here just because it has a high APY. So as you can see, if I open Nikola, you can see that there is now a new section here called lending info, and you can see that the demand is very high. So it has 3 bars of demand and the interest rate is 28.77%. If you were to receive 28% every single year compounded, you will become a millionaire with honestly not that much effort at all. So when something is too good to be true, most of the time it is actually too good to be true. We can see that the value of Nikola, for example, is a whole lot less than it used to be. So it is very volatile, and more likely than not, this company could be facing bankruptcy, and a lot of people do tend to short these stocks. If you don't know what shorting is, essentially you're betting against the company doing well, so you would borrow and the price will go down and you will make money like that. That is essentially a big strategy for CFD trading. That's why the demand right now is very high. What's going to happen soon is the demand is going to dry up and the APY is going to go all the way down to 0 because no one actually wants to borrow the stock. So as you can see, there are many different companies. Bed Bath & Beyond, for example, is another one that gives a return of 30% annual equivalent. Don't even assume the company will be around for a whole year for it to give you 30%, and definitely do not invest in any of these companies just because they pay a high APY. Now, out of curiosity, I can go into my portfolio and see what shares I have and how much I could be earning from this share lending feature. So let's go into AMD, for example, and then we can see the lending information. Currently, there is no demand for AMD, and as a result, there is no API, no earning interest on that. Same thing with Apple, there is no demand and no interest. So if I go into Aston Martin, same thing again, no demand and no interest. But when I first tried this, there was actually a demand for Aston Martin, and that has dried up very quickly. So I can't reiterate the fact that you should not look at share lending as a way of making income. You would almost guaranteed be better off by investing in good stocks or good ETFs that have a good future and give you profits through capital income and dividend payments. Okay, so when we go into BMW, we can see that it is the first stock that I have that has a very high demand. However, the APY is very low, and it doesn't make sense for me to buy more BMW shares with the expectation that I'm going to be making some interest through share lending. So like I said before, if you are an investor that just invests in ETFs, for example, the FTSE 250, let's go into that, more than likely there will actually be no demand for actually borrowing these stocks and shares. So you'll actually probably not be affected by the share lending feature. But that being said, you can always disable share lending whenever you want, and Trading212 has made it very clear and transparent how they lend shares and when they are being lent, what is actually going on. So make sure to check out some of my other videos, and I will see you in the next video.